crazy. Good afternoon. My name is Patrick Cox. I'm acting as a senior strategy analyst for Blackberry, and I'm going to be presenting to managers and executives of the firm who deal with strategy, who are today played by my mother and my father. Good, it's recording, and I'm in shot, and I'm not obstructing things. Okay. Good afternoon. Today, I'm going to analyze Blackberry's historical performance, our current position, and things that we can improve upon to offer us a path forward and generate growth for the company in the future. Blackberry's Q1 2020 investor report anticipated large growth primarily in cybersecurity. It based this around the Internet of Things, which Blackberry estimated to be a $22 billion market with a 27% compound annual growth rate in the future. Principally, Blackberry wants to operate in crisis communication and endpoint security, both of which it anticipates to have above a 30% compound annual growth rate. To help aid this, Blackberry purchased Cylance, which is a cybersecurity software and AI firm that it expects to add 25% to 30% growth to Blackberry's revenues in the future. Together, these mark a shift away from Blackberry operating as a product manufacturer of devices to a software company. But this has been ongoing since about 2011, with the culmination of what it expects to be its path forward as a completed firm in around 2018 to 2019. The problem is that Blackberry failed to meet these expectations. Cylance's annual growth rate was under 5%. Blackberry averaged just 6% growth, heavily weighting post-cybersecurity revenues. So this is weighting the last couple of years when Blackberry has had net income growth and favorable free cash flow assessments. Blackberry is failing to generate comparable revenue to other firms operating in the industry, given COVID-adjusted numbers and given favorable forecasts that operate on Blackberry's assumptions. Blackberry can fix this, though, by returning to chip manufacturing and the things that made it good in the past. To help clarify this, I'm going to analyze our current position, clarify the challenges that we face as Blackberry, provide a strategic solution to those challenges, and forecast the impacts of this solution. Consolidated financial forecasts currently show low growth potential. Blackberry is only projected to have a 12.91% revenue growth in the near future as a sustainable growth rate. But cybersecurity market growth is only projected at 10.4% where Blackberry operates, and Blackberry's Internet of Things market is only projected to increase at about 10.53%. Furthermore, Blackberry's return on invested capital stands at negative 1.56%. Normally, to be a successful firm, you want above a 2% return on invested capital. Graphically, Blackberry is projected much lower than its key competitors. The industry of the whole and CrowdStrike, the number one competitor in the industry, both have exponentially greater returns on revenue than Blackberry does. And this is including, once again, favorable numbers for Blackberry. Historically, our performance since 2011 paints a worse picture. We've lost an average of $331.6 million in net income a year, and we have negative 12% revenue growth. Those are atrocious numbers. Blackberry is acting as a billion-dollar venture fund, not a product manufacturing corporation, and it's not structured as either. This is severely inhibiting our strategy and in making it hard for us to continue forward as a sustainable company in the future. Blackberry acquired Cylance only. Normally, venture funds acquire multiple firms to help disperse their risk and mitigate the cost of one of those firms failing because venture firms are likely to fail. Blackberry's cash burn also makes it unsustainable for it to purchase more firms, and it makes it unsustainable for it to develop product, invest in R&D, and do other things that make it a successful product manufacturing corporation. Blackberry's lost market share from a failure to adapt successful strategies that it's had in the past to the current market that it's trying to operate in. Blackberry once offered itself as a global mobile phone device manufacturer, capturing 20% of the global market through differentiation. It offered a unique product. It then innovated upon that product, offering new and technologically advanced things that appeal to consumers. It leveraged both of these to capture the global market. Blackberry's current strategy faces strong competition in areas that it doesn't want to be operating in. Cybersecurity software is a crowded industry with low margins that doesn't really have a potential for Blackberry to grow in. Blackberry's existing endpoint security, it innovates through AI, which Cylance was a good investment for, but once again, it has a crowded industry and has low margins and doesn't offer really any chance for Blackberry to capture any of the other market share. 5G manufacturing, however, is a growing market, but Blackberry's operating in the wrong area. Traditional cell phone manufacturers are already crowding the market and have already taken much of the potential market share in the future. Refocusing our strategy will reflect our past success and generate growth for the future. To do this, BlackBerry should manufacture secure 5G Internet of Things chips. These are the physical chips that go into things such as thermostats, household appliances, and office appliances such as light bulbs, computers, copy machines, etc. These are connected to the network that you operate on, and thus it is essential that they are secure because they offer an endpoint for hackers to enter your system. Internet of Things secure chips have a brand potential market. Business to business is an option for BlackBerry to sell to, and additionally they can have individual consumers, and importantly they can utilize government contracts, which BlackBerry has been extremely successful with in the past. BlackBerry has experience in this market as well through licensing contracts and past performance as a software acquisitions. Restructuring creates market space and meets BlackBerry's needs. It reinvents BlackBerry's area on the strategy canvas. So it shifts it away from high competition, high hardware focused areas into a large market with potential growth and adaptability. Adopting these strategies also solves balance sheet forecast problems. I've run the future simulations based off the Edgar and SEC filings, and we expect positive free cash flow after 2 years. Additionally, we'll net between $60 million and $3 billion in net income between 2022 and 2026. We experienced 70% revenue growth after our first 2 years of positive cash flow. To temper these slightly, I've included a high standard deviation with a bias towards negative, and I've also included 2 years of negative free cash flow for BlackBerry's investment in further things, and also for BlackBerry's continued restructuring costs. Normally, when you restructure an entire firm, that's a really hard thing to do, but in this case, BlackBerry's already put in most of the work, and this cost is easily managed. Silence has already been acquired, and it provides AI and software that will help power the chips that we manufacture in the future. Additionally, BlackBerry has licensing contracts and facilities that already operate and produce chips for mobile devices. All it has to do is eliminate the mobile devices part of that, which it is not succeeding on anyway. BlackBerry has significant benefits in that it can still raise equity on the private market. Though its stock value has diminished slightly, it still has the ability to raise equity through stocks, issue debt, and do other financial mechanisms that help generate cash for BlackBerry. In conclusion, BlackBerry has a path forward by offering complete Internet of Things security chips. These help align BlackBerry's strategy with the structure of the company. They also help refocus on high margin, low competition areas that BlackBerry has achieved and succeeded in the past. And it also solves our balance sheet forecast problems, returning us to a profitable BlackBerry that will dwindle to around an 18% comparable sustained growth in the future.